The gentleman from Nebraska, Mr. Flood, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Bohr, one of the most detrimental regulations impacting the manufactured housing industry has been the Department of Energy's proposed energy conservation standards for manufactured homes. This regulation would impose stringent new requirements on the construction of manufactured homes, raising costs on one of the few affordable options for consumers, especially in rural areas like Nebraska, where I represent. Fortunately, the DOE has decided to delay the compliance date for this rule after significant stakeholder feedback. Can you speak to the impact this proposed rule would have on the production of manufactured homes?
Yes, thank you for the opportunity. The rules would, we've got processes under the HUD code where every plan for a house is engineered and approved. The rules would cause us to basically have to redesign every floor plan because of costs that are added in the weight of the house, the thickness of walls, the elevation of the roofs, number of windows that could be included. So it's really a complete redesign of all of our designs that would then have to go through a recertification process. The costs are, a lot of the costs involved are the actual changes to the design once you get through that process. But the other thing that's still undetermined is how the DOE rules would actually be tested and how they'd be, how the compliance process would go. We estimate that that could cost another $1,500. And what I'd like to point out is, we're talking about, it's hard to give you one number as far as the total cost because we've got different house designs and everyone's going to be a little bit unique, but I think a rough number might be for the actual changes to the design might be in a range of $6,000. There's a big range around that. Add another 15 potentially for the cost of compliance, which hasn't really been defined by DOE at this point. And so let's just say $700 to $7,500. That may not sound like a lot, but I'll make 2 points. One is the typical cost-benefit analysis looks at will that money get paid back for the home buyer over 10 years. Using DOE's analysis, which we do think is somewhat flawed, but we didn't change it. We just updated it for current costs. For the vast majority of our homes, it would not get paid back. And the bigger point is $7,000 for a customer that might be $50,000.
I appreciate your answer. I'm going to reclaim my time. You and I are on the same page. People need to understand that. I want to just switch gears here and go to the auto insurance market. The average California annual rate for auto insurance in 2023 was $2,462. Meanwhile, the average rate in my home state of Nebraska, $1,538. That's a striking difference of almost $1,000 annually. California fashions itself as the home of innovation, but its broken insurance and regulatory framework doesn't even allow drivers voluntarily to share telematics data with the insurers in exchange for lower rates to reward good driving. For those who may not be familiar with the term, telematics can be installed in a car to track speed, harsh braking, or other indicators that may affect an insurance rate. Basically, by allowing drivers to opt into this, you're giving them an opportunity to lower their rates by demonstrating they're a good, safe driver. Mr. Theodoro, can you discuss how the use of innovative technology like telematics in auto insurance could lower rates, something Californians miss out on and Nebraskans take advantage of?
Yes, thank you, Congressman, for the question. Indeed, telematics can lower costs. If we look at the history of automobile insurance rating, we start with bureau rating, where the rates were set, and then segmentation, looking at city drivers versus farmers, for example, looking at risk factors, and then more granular segmentation, and then the development of big data, so pulling in different data elements, because insurance companies are, by and large, in the data management business. They look at the data. So telematics data even makes it more specific, which it looks at things like hard braking or turns that are very abrupt, and it feeds this information back to the driver and to the insurance company so that the risk based on the quality of the driving helps to determine the price. So the capital is allocated according to the level of the risk. So it's sort of counterproductive to ignore this kind of data. It's being used in the trucking industry. Commercial auto insurance is benefiting from trucks that have front-facing cameras that look at driver behavior, are they falling asleep, and feeds this data back, and it
Thank you,
leads to
Mr.
lower
Thurdo.
costs.
I must yield my time.